I put in all this sweat equity, I'm finally making sales, but when it comes time to actually move the cash to my personal bank account, how do I do it without completely messing up? I hear this every single day. It is arguably the most common and, frankly, the most stress-inducing question every new entrepreneur faces. And getting it wrong? Well, it doesn't just cause bookkeeping headaches, it leads to massive tax penalties with the IRS. Let's dive right into this explainer and figure out how to properly get you paid.
So, I'm just sitting here, looking at my business bank balance and wondering, how do I actually pay myself? The honest answer is that it completely depends on how your business is legally structured. There's literally no one-size-fits-all answer here. A sole proprietor pays themselves very differently than the owner of a corporation. To avoid those ridiculously costly mistakes, we need to break this down structure by structure, starting with the most common setup: sole proprietorships and single-member LLCs. Okay, so if I'm a sole proprietor or a single-member LLC, what exactly is an owner draw? If you fall into this category, the IRS basically looks at you and your business as the exact same entity for tax purposes. You don't put yourself on a formal payroll. You get a W-2, actually scratch that, you do not get a W-2 or a traditional pay stub with taxes taken out. Instead, you take an owner draw. This simply means you are transferring money directly from your business checking account over to your personal checking account. No payroll withholding, no complicated math, you just move the cash.
Wait, really? So do I just pay taxes on the cash I actually pull out of the business? A resounding no. No way. This is exactly where people get tripped up. You are responsible for paying a 15.3% self-employment tax on your business's entire net profit. That 15.3% covers your Social Security and Medicare taxes, and it applies to literally everything you netted, regardless of how much you decided to actually transfer over to your personal account as a draw.
Let's look at the real-world impact of this. Say your business had an amazing year and cleared exactly $100,000 in net profit. But, you live modestly, so you only transfer an owner draw of $50,000 to your personal account to cover your living expenses. Wait, so I left 50 grand sitting safely in the business checking account? Am I taxed on that too? Exactly. The IRS doesn't care that you only drew out 50. You still owe that 15.3% self-employment tax on the full $100,000 of net profit. That money belongs to you in the IRS's eyes, whether you moved it to your personal bank or not.
What if I'm not flying solo, and I actually have a business partner? That brings us to structure number 1, partnerships, and dealing with multiple owners.
In a partnership, each partner takes their own draws, based on their ownership percentage.
So still no W-2, we just use a K-1?
Exactly right. Just like the sole proprietor, partners don't get a W-2. Instead, you receive a Schedule K-1. This document reports your specific share of the business's profits and losses, and you use that K-1 to report the income on your personal tax return.
Everyone loves to talk about this next one. Number 2, S-corporations and their elected status. If you have this, the rules of the game change completely.
What is this strict rule I keep hearing about when it comes to S-Corps? As an S-Corp owner, the IRS requires you to act as a W-2 employee of your own business, and you absolutely must pay yourself a reasonable salary. What does that actually mean, though? Can I just make up a number? Not at all. It means you must pay yourself a standard, market rate wage that reflects the actual daily work you do for the business. If you're acting as the lead marketing director, you must pay yourself what you would pay a marketing director on the open market.
So where do the tax savings actually come in if I'm forcing myself to pay a W-2 salary? That's the best part. Let's go back to our $100,000 profit example. Say a reasonable salary for your specific day-to-day role is $60,000. You put yourself on payroll for that amount, which is fully subject to the 15.3% self-employment tax. But look at the remaining $40,000 in profit. You can take that 40 as a shareholder distribution, and here's the magic. Shareholder distributions are not subject to self-employment tax. By splitting your income this way, you literally save thousands of dollars every single year.
Do C corporations work the exact same way? Not quite. Let's look at number 3, C-Corps, which are double-taxed entities. As an owner, you are once again just a salaried W-2 employee of the corporation. But there is a major drawback here that you need to be warned about.
Let's walk through the flow of money here. Step 1. The corporation files its very own tax return and pays a corporate income tax on its profits right out of the gate. Step 2. The corporation then pays out the remaining profits to you, the owner, as dividends. Step 3. You have to pay taxes on those dividends again on your personal tax return. Wait a minute. So the profit takes a massive hit at both the corporate level and my personal level? Precisely. That is exactly why C-Corps are famously known as double-taxed entities. The exact same dollar is taxed twice before you can even spend it. Okay, regardless of which entity I choose, what are the absolutely essential rules I need to follow to stay out of trouble with the IRS? Let's go through number 4, essential rules for staying compliant.
Let's run through these non-negotiable rules. First, never, ever mix personal and business finances. Always use a dedicated business bank account. Second, if you are an S-Corp owner, do not try to game the system by paying yourself an artificially low salary just to maximize those tax-free distributions. That will trigger a massive audit faster than you can blink. Third, remember your pay amounts directly affect your quarterly estimated taxes. Okay, so it's a huge balancing act, and I definitely shouldn't just be guessing my way through this.
You really shouldn't. You need to optimize your specific structure with a qualified tax professional. I highly recommend working with reliable accounting and tax services. They help small business owners handle bookkeeping, W-2 payroll, and high-level tax planning, so every single financial decision is optimized year-round. Getting the structure optimized is definitely vital, absolutely crucial, because at the end of the day, is your business structure designed to pay you or accidentally pay the IRS? Think about that as you review your accounts. Thanks for joining us for this explainer. We'll see you next time.